Hello, everyone. John Hutchinson with Traders Reserve's Filthy Rich Dirt Poor. Welcome back to day 3 of sitting in for Jeff Wood. We did move our topics around just a little bit. I basically wound up giving the When the Bear Market Ends presentation yesterday. So because yesterday's video was longer than I had anticipated, I just moved deck chairs on the Titanic here. So today we're going to do a quick look at inflation, the Fed, and then I want to share with you some background information on the concept that I discussed on Monday called the stack. So we'll get into part 2 of that today. And let's get started with inflation. Obviously the big driver for everything that's happening economically. I put this little table together to give you more of a numeric visual for what's really taking place as it relates to inflation. And one of the things that's not getting enough press or attention is the fact that at the producer or manufacturing level, prices have receded to more historically normal levels in the last 3 months. Maybe that trend continues into or through September and October, but it has so far. That's a pretty substantial decrease in the manufacturing end of the inflation problem. And at the service end, service sector prices are still elevated, but they have begun to recede as well, just not as quickly as the producer prices did. The battle that the Fed is losing is at the consumer level. That is where inflation is what we would say is out of control. 315% over target. The target rate for the Fed is 2%. It's currently running at 8%. This is why we stressed over the summer that if CPI moves in very small increments, it would make it more difficult for the Fed to justify slowing or stopping interest rate increases. And that's precisely what's happened. We need inflation to move by full percentage points lower, like 1%, 1.5%, something greater than a 0.5% or a tenth of a percent, like we've seen in the last several months. So this, we'll keep updating you this just as it's important. We know it's the problem, so I don't think we need to belabor it, and we won't. So from inflation, that takes us to the Fed and the yield curve. And I talked about the yield curve yesterday in yesterday's video as one of the keys to knowing when the bear market will end. And 2 points that I want to make about this slide. The first is the most important thing out of the Fed meetings in September and October is the terminal rate. That is, when does the Fed stop raising interest rates? What's that point? What's that number? What is priced into the stock market right now is 4%. If the Fed provides any language this month or next month that increases that terminal rate to 4.5% or even 5%, that will send the market substantially lower. It is not priced in. It would be a negative surprise. I am not predicting that, but I am telling you that that is what would happen if the Fed moves the goalposts on its terminal rate. When the Fed started the year, they set that terminal rate at 3, then 3.5. Now it's 4, so it's creeping higher, and inflation isn't moving lower. So one of those two sides has to give. The second point I want to make about this chart is, historically speaking, recessions occur 6 to 18 months after the yield curve or the 10-2 spread inverts. That inversion took place in April of this year, which means we have a time window, so to speak, of anywhere from 6 to 18 months from that. So this October to next October, if a recession is going to occur, it is likely to occur in or within the next 12 months. The yield curve has reverted to its lowest levels as of the close on Monday. It was trading at minus 47 basis points. The low is minus 50. The curve has to move back to zero. That's that is the signal that the bond market has more confidence in both the short and long-term economy, primarily the long term. Right now, the bond market isn't saying that. In fact, if you look at the April timeframe and the August timeframes, and let me pull up my little pen and I'll mark it out for you, because this is what caught my eye when I was putting this together. It's here and here. And in both cases, you could see the stock market going one way and the bond market moving in completely the opposite direction. Both instances, almost exactly the same kinds of moves. And then following these little low points in the yield curve, the stock market reverses direction. And it's essentially the bond market saying, you're going the wrong way, guys, and you need to turn around and come back. And the stock market does. And now it hasn't yet here. And that's the thing that worries me, is that with this far side of the curve, almost off the chart right now, being so much lower than it was just a couple of weeks ago, the market moving sideways is a concern. But again, we're straddling that 3,900 line in the S&P 500, which is a critical support line. So those are two things to keep, again, as I've said all week, and I know I'm repeating myself, those are the things to keep in mind. This is where we are. This is now what people are starting to predict, this projected terminal rate of 4.5%. And that, again, is not priced into the market. The Fed is not likely to jump to the 1% increases either this month or next month, certainly not based on a single month's data. And like the CPI from this month, the report from this month. So don't be surprised that the Fed more or less holds serve, but the rate that the amount that they increase the rates by isn't important. It's that terminal rate language in the Fed statement, which I believe comes out tomorrow at 2:00. So that's what we'll be watching for, and we'll report back to you on the occurrence of that. But keep your eye on these. If you see this significant divergence occurring again between where the market is and where the bond market is, that could be a signal to you that the market is about to reverse. Doesn't necessarily mean the market's going to reverse real hard, but it could be a signal. All right, so that's the inflation and Fed update. And I want to get back to the idea of the stack. So let's talk about this, because this is the entire reason that we are combining this economic morass of data and information with this idea of the stack is simple. We have found something that works in bear markets and want to share it with you and show you how it works and obviously what it is. And as I said in Monday's video, this is an options trading strategy. It has a simple objective of collecting weekly cash income using lower risk tactics across a range of time frames. This concept has taken us 15 months to arrive at. And the reason is because we've been testing it for well over a year in one of the worst market environments we could possibly test anything in, which is perfect. And I know it sounds weird, but this is exactly the kind of market that I would prefer to test something in, because anybody can make money when the market goes up. Not everybody can make money when the market is like this. So over the last 15 months, we've tested more than 20 options trading tactics. Our goal was to identify the best performing tactics. That does not automatically mean the highest return tactics. It's a combination of factors, which I'll share with you in just a moment. We specifically were looking for tactics which could produce consistent income, and we became more focused on tactics which could produce weekly income, and combining that with tactics which had lower capital requirements. Now think about this from a capital allocation or capital management perspective. In a bear market, it is important to protect or preserve capital. That's a Captain Obvious statement, I know. But what's hard about that is how do you keep maintaining or generating income or growth for your portfolio when the market is doing this? And one of the ways that you can do that is by using tactics which require less capital without sacrificing returns. When we put those two bullet points together, that's what we were looking for in this testing. The time in trade was a major factor because we needed to produce consistent income, and ultimately we wanted weekly income. Therefore, we needed to know how long it took for these trades to work out, and whether or not they could fit that concept of producing weekly income. So you could see the range here of 4 to 160 days. Well, you're not going to use that 160-day tactic because you can only make that kind of a trade twice a year. A trade that only takes 4 days to complete is far more profitable on an annualized basis because of the frequency with which you can make those kinds of trades. And we also wanted tactics or trades which could be defended or rescued, meaning if we got stuck, let's say we put a trade on this day in the middle here where the market turns, and then, we're in trouble the next week. We wanted a way to identify tactics where we could either significantly reduce or limit the loss on that trade, or even rescue that trade back to break even or profitable. Those were the types of tactics we were looking for. And along the bottom down here, you can see we have this range of returns from 2.8% up to 59%. I can tell you that the 59% trade did not make the cut. So don't get excited. Neither did the 2.8%, so don't worry. But the range was important because it helped us, again, to identify which were the best performing tactics and tactics which produced the consistent income. The average return across all of the trading tactics we tested was 21.25%, and the average days in trade is 21. That means that's 21 days from opening the trade to closing the trade, regardless of when or how income was produced. For example, one of the tactics that will be highlighting in upcoming videos here is a tactic that you can place every week and it produces income every week. Another is a tactic which has a 28-day lifespan, but because you can use this tactic multiple times, it fits the objective of producing weekly income. When I get into more details about the tactics themselves, that will make sense. But the reason I highlight the average days in trade is, again, when markets are moving in these kinds of directions, it is much more difficult to use longer dated trades, and it is easier to move with the market, to have the flexibility to move with the market on a weekly basis when you have a shorter lifespan trade. So with that, here were the 4 factors. Aside from the setup that I just provided with you, these were the 4 factors we focused on when choosing the trading tactics. It was the frequency of the trade, how often could we use it, the consistency of the trade, which is 2 parts. One part is, were we able to make or place these trades on a consistent basis? Was the premium available? Were the strikes available? Was the volume, the open interest available? So the consistency of being able to make the trades, as well as the consistency in the returns. Probability, which is win-loss rate. We needed tactics which had 75% or higher win rates. And finally, performance, which is the overall annualized potential of the tactics, which I will share with you in one of the final videos this week. So from those 4 factors, we built the stack. And the stack is this collection of trades which produce weekly income using a range of time frames from 4 days to 45 days. Again, producing weekly income, even though it's a 45-day trade, it's still producing weekly income. But all of these tactics have the same 2 core components. They require less capital and they carry lower risk. but they produce that weekly income. In tomorrow's video, I'm going to walk back through the stack. I'll break this down a little bit further, and then I'm going to share with you performance and results. But I want you to start thinking about this. If you had a group of trades, here's a secret tip: 4 trades, 4 tickers. That's all it took for us to get the results that I'm going to share with you tomorrow. 4 individual tickers across these 4 tactics, 4 trades per week. That was all it took. So it is not, you don't have to manage this on a daily basis or an hourly basis or a to-the-minute basis. This was as low time intensive as we could possibly make it. But tomorrow, performance, results, I'll take you a little bit deeper inside the concepts here. But again, imagine if you had those 4 trades working for you, producing weekly income, even in a bear market. That's what I'm most excited to be sharing about you. Don't forget that we'll be sharing it in our upcoming webinar on Monday, September 26th at 4 p.m. You can get your seat right here on this page. Use the button directly below this video, and we will be taking you much more deeply inside the concept of the stack. For everybody here at Traders Reserve, that's Filthy Rich Dirt Poor for today. And I will see you tomorrow when we talk again about the stack, performance, and results. Hope everyone has a great day, and see you again tomorrow.